It's going to be worse than 2008. I'm your host, Steve Van Metre, and thanks for joining me today. Legendary investor Michael Burry is warning investors they're going to lose big, and what he sees is a nightmare scenario. Let's head over. We picked today's story up with his headline: the big short investor Michael Burry sounds the alarm on shaky markets and fears a worse disaster than the financial crisis. He tweeted recently, "Today I wondered aloud if this could be worse than 2008. What interest rates are doing, exchange rates globally, central banks seem reactionary and in CYA mode. One of my analysts said it was spooky that today I would wonder that Alpine anniversary." And Burry was likely referring to the Federal Reserve and other central banks frantically raising rates to curb stubborn inflation. The Fed's aggressive hikes, combined with overseas headwinds such as the Russia-Ukraine war and continued lockdowns in China, have driven the U.S. dollar to record highs against other world currencies such as the British pound. And something we've talked about on this show is not just the fact that we're seeing this divergence between exchange rates and the dollar moving higher. It's the speed at which the dollar is moving higher. When we look back in history, we've shown on this show that when the dollar does that, usually something occurs shortly thereafter that involves the word crisis. And here we can see, looking at this chart, we have the nominal broad U.S. dollar index, that's shown in red, against the federal funds rate in blue, both on a year-over-year rate of change. And notably, we see these spikes in the dollar. Here we see one during the great financial crisis. We see one in 2015 that almost led to a global recession. And here we're seeing it again. Now, this time, what I think is different and what Burry is suggesting is that you'll note that the federal funds rate in blue doesn't move that much normally. In fact, central bankers are normally very slow to move the funds rate. But this time, that big spike in the funds rate on top of this big move in the dollar saved that we could be facing a nightmare scenario. Other experts have voiced similar concerns, warning an overzealous Fed could plunge the U.S. economy into a deep recession or spark stagflation, where inflation remains high but growth stagnates and unemployment jumps. They have also cautioned that volatile markets and a loss of trust in policymakers could threaten consumer and investor sentiment, undercutting growth. Now, is inflation going to come down? Well, we'll save that for the later part of the show, but unemployment most certainly is likely to head higher. Check this out. On this chart here, we've got the 4-week moving average of initial unemployment claims in blue against the Wilshire 5000 price index, the U.S. stock market. Not only is it on a year-over-year rate of change, but I inverted it. So when you see the red line goes up, that means the stock market's going down. And notably, look at the relationship here. You see that as red goes higher, stock markets go down, unemployment claims rise. And we see that happen throughout history, suggesting that this sell-off in the stock market just hasn't actually been absorbed into the broad economy, and we haven't started to see initial claims rise, but when we do, there will be nothing stopping them. Big short legend Michael Burry warns stocks will keep falling, and many predicts investors will suffer heavy losses. The investor of the Big Short fame noted in a Friday tweet that there were 218 companies with a primary stock listing in the U.S., a market capitalization north of $1 billion, and annual losses exceeding $100 million. Now, what are these companies called? These are called zombies. When you have a company that is losing money and has to borrow money to stay afloat, it's called a zombie. And he's saying we've got hundreds of them. Of those, 29 boast market caps over $10 billion and are worth a combined $655 billion, he added, suggesting that this indeed involves part of his nightmare scenario where these companies go bust. Another feeling I'm getting is mid-late 2000, free cash flow totally on sale and ignored while former momentum stocks are coming down, but not far enough, he added, and darling, better businesses still had a ways to fall. Value was about to take off for years despite more crash on the way. And what he's pointing out to is here's a chart of the NASDAQ 100 going back to, of course, the dot-com bubble. And what we note is he's saying, hey, I feel like we're right here. The peak's already passed. Here we are. And what we're on the edge of, that big crash that he noted, is yet to come. The difference between now and 2000 is that the passive investing bubble has inflated steadily over the last decade. All theaters are overcrowded, and the only way to get out is by trampling each other, and the door is only so big. Now, what is he talking about here is the rise of passive investing is causing people to have an over-concentration in certain stocks. And what Burry is suggesting here is that as the market goes down, as a crisis evolves, that what will happen is people will want to sell, and they'll realize that there's no one left to sell to, and that everybody, not only that, is selling the same thing. And there's one thing that shouldn't get trampled if Burry's nightmare scenario plays out, and that is your portfolio. I'll put a link up here to Portfolio Shield and description below. Let's continue on. Because just remember, he says, I was feeling greedy on the long side in 2000. He got crushed too, learned his lesson, and maybe so will you. Last week, Burry tweeted that he was concerned about the current market conditions are shaping up to be worse than 2008, when the implosion of the U.S. housing market had a cascading effect that tanked the market for years. But are there warning signs that we're seeing in the housing market? Well, we'll get to that in a moment, because a lot of people think the market is bottomed or really close to it. But Burry says, no way, not even close. In this tweet, he notes 13.48% of stocks closed above their 200-day moving average, and that means above their average price over the last 200 days. Bottom of 2009, he says 1.2%. Bottom of 2020, 2.8%. Currently, December 2007 levels, suggesting that we've got a ways to go before we see a bottom. But what about the housing market? Well, there are some signs that say that the worst for it is yet to come. As mortgage applications plummet 14% as higher interest rates and Hurricane Ian crushed demand that's already been crushed. Total mortgage application volume fell a whopping 14.2% last week compared to the previous week, some of this due to Hurricane Ian. Refinance volume, which is the most sensitive to weekly interest rates, as they go higher, demand goes down, dropped 18% for the week and was 86% lower than the same week a year ago. Mortgage applications for purchasing a home fell 13% for the week and were steep 37% lower from a year ago. And this is really bad news for the housing market. As people say that, hey, they believe that rates need to go higher, that the Fed isn't doing enough, and that monetary policy isn't tight enough. Well, I'll have this to say in a recent tweet, that for those of you who don't think rates are high enough and perhaps the monetary policy isn't tight enough, ask your local mortgage professional, loan officer, underwriter, etc., how business is, because with this data, what we're seeing is there's going to be a massive amount of layoffs in the mortgage industry, and that will turn into the housing market. Just think, if people aren't going out and getting a mortgage for a new home, guess what it means? They're not buying a new home. But does this mean the Fed's going to quit? Well, not so fast. Fed official says inflation fight will take time despite signs of progress, as Governor Philip Jefferson said he remains concerned that consumers will expect higher prices to persist. Well, don't worry, they won't. While oil and gasoline prices have come down in recent months, he says, I am concerned that fluctuation in prices of the goods to which people pay the most attention, like food and housing, will affect expectations of future inflation. And the question is he right? Well, no. Well, here we can see, at least on the one part, he does note that oil and gas prices are coming down. Here on this chart, we have the Consumer Price Index in blue, which we'll get an update on next week, and U.S. regular all formations gas price, both on a year-over-year rate of change. And notably, there is a very strong relationship here. We can see that gas prices have peaked and have come down over on their year-over-year comp, telling us that inflation is likely to follow. But he also mentions that food prices could be sticky. Well, we've got a chart for that too. And here's a chart of the Consumer Price Index, again in blue, now overlaid with the global food price on the food index in red, and we can note that it too is coming down. Now, as we've talked about on this show, and then when I've talked to our chief strategist Jeff Snyder about, we note that prices aren't likely to come down. It's the key part here. It's the rate of change that matters most. In a market with more job openings than workers, the competition to fill vacancies is leading to a rapid wage gains now, he said, and thus resulting salary compression may lead to further upward wage pressures in the future. Of course, well, that is the belief, is that we're going to continue to see wage gains. But here's the issue. When you see the economy slowing down, yes, people have gotten higher wages. They've gotten wage increases from, of course, inflation, and they demanded it. But as the market for goods and services goes down, what will employers eventually do? They will lay people off. And who do they tend to lay off the first? Well, that is right, the higher priced employees. And is there signs of demand slowing down? Well, you bet. Here in this chart, we've got advanced retail sales in blue overlaid against the Wilshire 5000 or total U.S. stock market in red, both on a year-over-year rate of change. And what we can note is as the red line, as stocks go down, demand for retail sales goes down. And that, again, brings us back full circle that as the stock market goes down, unemployment goes up, demand goes down. But will wages stay up? Will we see the housing market turn? No, not as far as the labor market goes, at least not today. The U.S. companies had 208,000 jobs in September, according to the ADP data, with gains driven by transportation, utilities, and manufacturing. But that won't last long because of surge employment in trade, as we're seeing now in the data. The trade is starting to fall, but nearly 3/4 of the increase in private payrolls last month was driven by a surge in employment. The question is, will it last? And the answer is, I don't think so. But the really story is, will Michael Burry's nightmare scenario play out? Will it be worse than 2008? Well, I'll let you decide. Weigh in the comments and we'll see. For now, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.